Okay, well, we're moving more on in chapter 8, and we're going to start talking about intangible assets. And so this really shouldn't take that long. The difference between an intangible asset and a tangible asset, which includes property, plant, and equipment, is really based on physical presence, so to speak. They're an intangible asset, especially in Nashville, is pretty important because, again, we're Music City. So we have a lot of musicians, and those musicians own copyrights. And copyright, although you can see the music on a sheet of paper and you can see the words, the lyrics, that's not really the value. The value is someone being able to sing that. So a trademark is similar to that. Copyright for a book is you have the book, but really it's the ability to reproduce that book is the intangible asset. So intangible assets are rights, privileges, and competitive advantages that result from ownership of long-lived assets that do not possess physical substance. They may be evidenced by contracts, licenses, or other documents. And here are some patents like the Nike swoosh, a trademark, which is McDonald's, copyrights, which again is the right for a book or a song, trade names, franchises, leases, and goodwill. And goodwill we'll talk about. So if you look at this graph, you can see that in 1975, that 83% of the assets a company had for the S&P 500 were tangible assets, buildings, equipment, furniture, cars, computers, etc. That was 1975, so that was 20, almost 50 years ago. And now in 2020, it has changed because businesses have changed. I mean, a lot of the largest companies are Apple, NVIDIA, although NVIDIA is a company that does manufacturing, but they have intangible assets, copyrights, software code, things like that. So these are things that do not necessarily have physical presence, but it is has become a significant part of a lot of the S&P 500. So again, it has shifted. So in 50 years, it's basically shifted from mostly tangible to mostly intangible assets. Intangibles are grouped into two different groups. Limited life intangibles. So limited life intangibles basically have they the length of time that the intangible has value is limited. So it's like depreciation. We'll allocate the cost of the asset's useful life. Now, property, plant, and equipment, you show the decline of value through depreciation. For limited life intangibles, that expense is going to be amortization. And so the same process, decreased asset account or increased accumulated amortization. So in this case, you don't have to have a contra asset account. You could just simply decrease the asset, unlike property, plant, and equipment. And I'm not sure why they came up with that distinction. However, with limited life intangibles, which are copyrights, because copyrights have an existence, patents have a life to them. So you're going to amortize them. So you can either write down the asset value or create an accumulated amortization, where it's just like cost of the asset and depreciation. You add those together, that gives you your book value. Indefinite life intangibles should not be amortized. So you're not going to expense something each month. So here's amortization of a patent. Again, you could just simply Hit amortization expense, which goes to retained earnings, and then you just decrease the patent by the amount of the amortization expense instead of having, again, accumulated amortization. Patents are good for 20 years, and that's from the date of the grant of the patent. The cost of purchasing a patent is added to the patent account and amortized over its 20-year life or its useful life, whichever is shorter. If you buy a patent from someone, it's normally not going to have a 20-year life. The costs in developing a patent are expensed. So all R&D are expensed. And so that's one of the reasons why the profit margins are so high with software companies, although they do expense R&D each year, so that is a cost. Legal fees incurred successfully defending a patent are added to the patent account. Copyrights are good for 70 years after the death of the creator. So I don't know if any of you read Stephen King, but once Stephen King dies, his family will have the rights to his books for 70 more years. That means, though, that if you wanted to create a book about Shakespeare and put in all his plays, you're welcome to it. No one can prevent you from doing that. It includes the cost of acquiring and defending it, amortized over its useful life. Now, intangible assets are worth a lot of money. Here are some artists here that probably you've heard most of, or heard about most of them. I don't know who Ryan Tedder is, but I know the rest. They're more my generation, I think, than yours. Um, this is from USA Today: The Sound of Music: Why Major Musicians Are Selling Their Catalogs. But Bruce Springsteen sold his music catalog for over $500 million. So did Bob Dylan. I like Bruce Springsteen. I'm not a big Bob Dylan fan. Uh, David Bowie, $250 million. Paul Simon, $250 million. Now they no longer have rights to their songs, but they've got $250 million less expenses and taxes and all that. So apparently they thought it was a good deal. So intangible assets are worth quite a lot. And lately, I believe that Michael Jackson sold his half of his, or the estate of Michael Jackson sold half of his copyright of his music catalog for $500 million. So that makes his whole music catalog worth $1 billion. And Katy Perry, I believe, sold her music catalog for $300 million. Trademarks, again, a word, phrase, jingle, or symbol that distinguishes or identifies a particular enterprise or product. Wheaties, Monopoly, Sunkist, Kleenex, Coca-Cola, Big Mac, and Jeep. Provides 20 years protection and may be renewed indefinitely as long as the trademark or trade name is in use. And franchises, contractual arrangement between a franchisor and a franchisee. Goodwill. So when you buy a company, it's the one time you get to actually tie the market value of the asset to the asset. Now, again, we normally will put assets on our books at cost. And let's say that we have a building in Nashville that we bought 10 years ago, and we bought it for $1 million, and now we're depreciating it over 30 years or so. And so after 5 years, the net book value of that asset is, let's say, $950,000. But everybody knows that Nashville is a booming market, so that $1 million building, could now be worth $2 million. Now, if we were to buy that company, we would put that uh, asset on our books for $2 million, not for the 950 net amount that the company we're buying has it on their books for. Or if we were to buy the building outright, we would put it on our books for that amount. But when you buy a company, you have a price that you pay them. And so let's say it's $10 million, or we'll have an example here in a minute. But the difference between, okay, so we offer them $10 million, we're going to pay them $10 million. And then we go and look at all of their assets, all of their liabilities, and we will then evaluate them and put them on our books at the current fair market value. And hopefully that's going to raise the value of these assets. Then after everything's said and done, we're going to have the sales price, and then we're going to have the net price of the assets minus the liabilities. The difference between those, between the what we pay and the net asset value, is what's called goodwill. And goodwill really represents exceptional management, desirable location, good customer relations, something that is intangible, really, that has made that business do well. If you were to buy the patent of Coca-Cola, I think you would pay a lot more than what the patent is worth. Maybe not, but what you're going to be doing is valuing this based on cash flow. So goodwill, as you see here, is recorded as the excess of cost over the fair value of the net assets. Now, hopefully this business is going to go on for years and years and years, and you're not going to have to you have no definite life. So this is an intangible without a definite life. And so you're not going to amortize it. You're not going to expense anything. Here's the slide that shows you that goodwill is the difference between the cost, what you pay, and the net and the fair value of the net assets. Okay. So you're not going to expense anything, but every year you're going to have to make sure that it still is as valuable as what you paid. Let's say that we did buy the formula for Coke and we paid $50 billion for it. I think you probably have to pay more than that, but let's say $50 billion. And so we're going to base that on cash flow. And we're going to go, all right, how many Cokes do we think we can sell over the next 30 years or so? And then we're going to go, well, what's going to cost us, et cetera. So we've got a cash flow, and then we look at our rate of return, and that's where we come up with $30 billion. But let's say 5 years in, someone is able to exactly match the formula for Coke. So there's no difference in taste between our Coke and their Coke. And again, Coke's been around for over 100 years, so they have no patent protection anymore. Well, now we have a competitor. And so now we're not going to sell as much. And so our cash flow is going to decline. And so we have to determine that amount and do an impairment again and write down the cost of that asset. So we don't expense anything, but every year we're going to test and make sure. So the first 5 years we would have looked and said, hey, do we still think we're going to sell as many Cokes as we thought we would? And if we say yes, then we go, okay, we'll just keep it on the books. But at year 5, when someone is able to exactly replicate our formula, our patent or our formula is not worth what it was. So we have to expense that decline in value. And this is what happened at Kraft Heinz. They bought Kraft and Oscar Mayer trademarks and other assets. And again, they said, okay, we're going to buy these. How much macaroni and cheese and how many hot dogs do we expect to sell? And so we come up with an amount, that cash flow, and then find out, well, we're not selling as many, and we don't think we're going to sell as many. So now Kraft had to write down that purchase price, which is an impairment of $15.4 billion. Now, if you're a shareholder, you're not too happy with that because that costs you $12.6 billion and $10.34 a share. Probably cost you more because then the value of those shares probably went down even more. So again, we have all these patents, copyrights, new processes, new products. Okay, R&D costs are expensed when incurred for GAAP purposes. All right. So again, the allocation to expense the cost of an asset is amortization, rights, privileges, and competitive advantages that result from ownership of long-term assets that do not possess physical substances and tangible assets. An exclusive right guaranteed by the federal government to reproduce and sell an artistic or published work is a copyright. A right to sell certain products or services or to use certain trademarks or trade names within a designated geographical area is a franchise. And costs incurred by a company that often lead to patents or new products are R&D, research and development. So how do we report this? Well, these are long-lived assets, so they're long-term assets. Property, plant, and equipment, you can see here, we will land, no depreciation, buildings, accumulate depreciation. So the net amount, patents, trademarks, goodwill. If we had an amortization, we might put that in there, but you can see we have $900 in goodwill, $900,000 in goodwill, which we will again test every year to make sure that's still as valuable as what we thought. Here are some financial information on JetBlue Airways, and it doesn't have a date, so I'm not sure what it says, but they had net income of 569 million, not bad. Beginning total assets of 10.9 million, ending total asset of 11.8. All right, and so they have a return on assets, asset turnover. Profit margin, this is something that we'll get into when we get into analysis, but this is going to be something you'll need to know so you can compare that. So let's look at JetBlue's profit margin is 7%, Southwest is 10.2. So Southwest keeps 10 cents on every dollar of sales. All right, so we're not going to cover any more of this. That concludes chapter 8 and on to chapter 9.